Hey guys, today I wanted to take a look at Apple, ticker symbol AAPL. The 52-week high was $198.23. We have since dropped down to about $173. Now, a lot of people are saying that Apple was overvalued when it was hitting $198. And now that Apple is starting to slide, I wanted to see if I could find a really good entry point for Apple. And to do that, I was going to run Apple through my valuation spreadsheet. I was going to run it through Graham's model, the discounted cash flow model, and the dividend discount model. And then these two intrinsic valuation models are for REITs only. And then once we finish, and I'll show you where I can get these numbers from. And if you'd like to follow along with this calculator and do some of your own intrinsic valuation, you can head over to Patreon, and I do offer this calculator over on Patreon. But for today, we're going to take a look at Apple, and just answering these questions here, we'll say no. So since this is not a REIT, we will not be using these two valuation models, just these three. Are we going to apply a margin of safety? We're going to say yes. And then what is the margin of safety? And this right here is my margin of safety guide. And again, this is just a guide. You can choose any margin of safety you like. But with Apple's market cap size being one of the largest, I believe it may even be the largest in the stock market, it being the highest market cap size, and depending on how far you are from retirement, you can be a little bit more conservative with your investments if you're farther off in retirement. So we're going to apply a 12% margin of safety and say we are at least 15 years from retirement. So this is just a guide if you'd like to follow along to be able to try to estimate your margin of safety. The first valuation model we're going to take a look at is Graham's model. And for this calculator, all you need is two figures right here. And the calculation for Graham's model is built in this formula right here. Simply takes the earnings per share, multiply by 4.4, multiply that by 8.5 plus 2 times the growth rate, divide that by the AAA corporate bond rate. And the AAA corporate bond rate is a quick Google, but it's sitting around 4.8. And when you do this, you do not put in percents, you just put in the decimal place. Now for the growth figure, Graham is really big on taking the earnings per share and evaluating earnings per share. So we're taking a look at Apple's earnings per share growth rate over the next 5 to 10 years. And we're going to find that over on Seeking Alpha. If you want a subscription to Seeking Alpha, I believe right now they're running a 7-day free trial if you sign up for Seeking Alpha. The link is in the description. So coming over on Seeking Alpha's Apple page under earnings and earnings estimates, if you come down here and you check out their estimated year-over-year growth, this is analyst estimates. They're estimating, 40 analysts are estimating a slide here by the end of September, negative 0.72. But if you go 5 to 10 years out, it looks like we're averaging about a 10% growth, earnings growth per year over the next 9 years. So we will use 10. And again, we can play around with the numbers. Once we click go here and we see what the valuation is, we can play with the numbers and play around with the numbers and see what we get. The discounted cash flow model, we have to find at least 10 years of free cash flow. And we can actually find that on Seeking Alpha as well. One of the reasons I like Seeking Alpha so much is there's so much data that you can find just on one website, and you don't have to have 15 different tabs open. You can just use Seeking Alpha. Under their financials tab, under cash flow, if we come down to the supplemental items, we see free cash flow per share. You can see that they're growing their free cash flow per share at a pretty good rate here. The data goes all the way back to 2013, but we're going to take 2014 numbers, $2.05 per share, take it all the way up to the 12 trailing months, and then we have to multiply this figure by the number of outstanding shares. Now, where are we finding outstanding shares? Come over to the balance sheet, and we have total common shares outstanding. You can see there is a slight decline in outstanding shares, and this could be due to some share buybacks from Apple. So take your free cash flow per share number and multiply it by the number of total outstanding shares for each year. And when we do that, we have free cash flow growth like this. Now, the brains of the calculation is happening over here. and we can see the free cash flow growth, very similar to their earnings per share growth. Averaging out their free cash flow share growth, we get around 10.35% average growth over the past 10 years. Coming down to perpetual growth rate, and this typically for a DCF valuation, intrinsic valuation, we're going to use anywhere from 0.5% to about 2 to 3%. Now, Apple is a growth company. It is going to be growing faster than most of the other long-standing dividend companies inside the S&P 500. So most of the time, I choose about a 0.5%. And for this calculation, I'm going to choose a 1.5% for the perpetual growth rate. The discount rate, typically I'm putting in 8% here. The total cash they have on hand and the total debt, that is a quick peek over on their valuation tab under Seeking Alpha, coming down to total debt and total cash, $62 billion for cash and $109 billion for total debt. Moving on to the dividend discount model. Now, the dividend discount model isn't going to give us an accurate number for the valuation just because Apple is using all of its free cash to be able to innovate and grow their stock price and grow their free cash flow. They're not giving a lot back to shareholders in the form of a dividend. So this valuation, the dividend discount model, is going to be slightly lower than what we would expect for a long-standing company that is paying a very decent dividend. But we'll fill this out and see what the dividend discount model gives us and take that into account when we look for our average valuation and then after we apply our margin of safety. So where are we going to find this dividend discount model numbers? Coming over again to Seeking Alpha, and this is why I love Seeking Alpha so much. They have so much information just on their each stock's webpage, individual webpage. Coming down to the dividend subtab dividend scorecard. They have been paying a dividend and growing it for the past 9 years, and their 5-year growth rate is close to 7%, but their payout ratio is only 15%, which gives you only 96 cents per share at $173 per share. But for the valuation model, we're going to need this figure here, 96 cents, and 6.69% for the 5-year growth rate. Putting those numbers in the calculator for the dividend discount model, these two numbers here, the risk-free rate is typically the 10-year bond yield, and that's sitting around 4.5% right now. And the return of the market, typically I'm going to put 8% in here, but sometimes this dividend discount model, which is technically the Gordon growth model, if your 5-year dividend growth rate is higher than your return of the market, you can break this calculation. This calculation is used for companies that have a very conservative 5-year dividend growth rate. Anything above return of the market basically means that this stock is going to outgrow the market and be the best fund in the market if it grows infinitely using that 5-year dividend growth. If that doesn't make any sense, don't worry. I'm just saying, if this does show a negative number, take that into account, that if your 5-year dividend growth rate is unsustainable, something like 15 to 20%, then you are going to break this calculation. You might have to drop it down to a more reasonable 5-year dividend growth rate. If we go ahead and click go, we find that we do have a sell position here, but let's take a deeper look at the valuation. Right now, according to Graham's model, intrinsically, Apple is valued at $155, where their current price is $173, so slightly overvalued based on Graham's model with no margin of safety applied. The discounted cash flow model is valuing Apple at $198, which is actually very peculiar because it peaked out. Remember, Apple peaked out at around $198.23 over the past year. So the discounted cash flow model is one of the most accurate intrinsic valuation models you can do for a stock. Now here we see the dividend discount model. Remember what I said. The annual dividend payout is fairly low for Apple because they're not returning the value to their shareholders in the form of a dividend. They're returning value in the form of free cash flow. So if we simply remove the dividend discount out of our average valuation, that does move the average valuation up to $176, which is over the current price. And with a 12% margin of safety applied, we reach a intrinsic value of $155 for Apple. So depending on your time till retirement, let's say you're 30 years and you do not want to apply a margin of safety, that would then tell you that you would be it would be a safe bet that you are going to make a ton of money in Apple if you don't apply a margin of safety. And if you invested in Apple at $176 right now, it hits your buy point, you're going to make money over the course of the next 30 years with the current projected growth rate. Let me know what you guys thought of this intrinsic valuation. Head down in the comments. Let me know what you want to see next. And with that, thanks for watching.